morning, everybody. This is Fred Meissner, and welcome to the Fred Report Technical Market Call for November 17th, 2011. We're in New Jersey at a seminar this morning, and we're speaking at about 11 or so. So I'm going to be a little quicker on this call than we have been, but we'll get to your questions. And so with no further ado, we're going to jump right into this thing. First of all, this market is trading an awful lot like its options expiration, which in fact it is. So far, the range on the OEX, which has got a lot of expiring options, is 568.32 on the high side and 552.16 on the low side. And surprise, surprise, it's at 554.52, very close to the 555 strike. We actually think that the OEX is going to expire around 560 this week, which means up about $5 or so from here. We could sit down today and then do that tomorrow. We also note, by the way, that one of the best-looking stocks in the OEX and one of the biggest components is IBM. You note that that stock is trading at 189.97 and 185.64 in a range. My guess is IBM can close at least 185 by the expiration period, and more than likely at 190, which would kick the market up a little bit. We, of course, acknowledge the fact that there continue to be these problems out of Europe. We're still keeping our stop on the S&P, on the SPY, at 120 on this market, which we do not think will be hit. We notice that there is a triangle on the S&P, which we have broken down out of. It needs to be revalidated by closing over 125. Having us revalidate that triangle, or actually breaking that triangle, isn't a huge concern to me. A number of people have been writing about it. It seems to be fairly widely acknowledged, and very often these formations don't work in options expiration week. So I'm not super concerned. I'd be much more concerned about a break of 122 and then 120 on the market. That would signal to me that we're going back to a neutral here, and that some of these European problems and such really are going to have some effect. But again, we think a lot of those are discounted. We've been asked by many for a 12-month target on the SPY. I think part of the reason for that is the strategists at Merrill Lynch just came out with a new target on the S&P of 1350, which would translate to 135 as a 2012 objective. We're a little bit more positive than that. I really need to see the closing year-end numbers to get a perfect target for me, but I would say my maximum is 147 on SPY. My minimum would be around 141, 142. We have been using a target of 140 for this year. We note that the weekly moving averages on the S&P are still positive, but they've just gone positive, and what I think we're doing now that they've gone positive is actually working off a bit of an overbought condition, and as that condition works off a little bit this week, we should see a good week next week and possibly also a good week into the end of November. Sentiment indicators are still nicely elevated. The bearish sentiment is still in the 30s, so we're very happy about that. And I don't see anything horrible, at least in the technicals, to derail our idea of a year-end rally. Obviously, if something really wacky fundamentally happens in Europe, that can trump any technicals. And so, again, we're going to keep a stop on the market at 120 for our opinion, but we're basically fine. In terms of the bond market, the TLT is confounding us nicely. We're still in an inside week on the TLT. It's just sort of fluctuating around. It is overbought short and long term. The accumulation model, though, will not go down, and that's my sort of real problem with this market, but we're still looking a little bit bearish on the TLT overall. We still think that corporate bonds look a little bit better than the TLT, and we note that they are actually now oversold and in position to rally. So we think if some of this fear comes out of the market, we're going to be in pretty good shape. While all this has been going on, our big seasonal trade is the oil trade, which is basically the end of October, November, December, January. We note that crude oil has been going up rather neatly into that period, and also heating oil, which is much more of a sign of actual demand. Crude can be a reflection of economic expectations, but heating oil is real demand. And we noticed that heating oil and crude oil are both advancing, as are the XLE and some of our favorite stocks in there. We'll talk about a couple of those in the call. We noticed that Chevron, though, for example, seems to be right around 100 after literally making a new high for the move. It's dropped about 10%. We would be looking, by the way, at any stock in any sector that is down 10 to 15% from its highs as a possible stock going into a year-end rally situation. Those are where the performance is. We've had some questions on gold and GLD, and the first thing is GLD looks like a consolidation here. Any GLD move above 177 would bring our target of 210 into focus. It would imply higher into year-end. We still have a 10-month target on GLD of 210 or 2,100 an ounce on the COMEX contract nearby, whichever occurs first. We've had a question on GDX versus PSAU. These are both very similar. We prefer PSAU very slightly, but GDX also looks good. The main takeaway here is these gold stocks and commodity stocks look to be in the top tier performers to us going into the end of the year, so we want to be sure that we have a position in commodity stocks going into the end of the year. We'll talk very quickly about currencies. The euro's pulled down, but it's still making higher lows, and it's quite oversold again. We're still maintaining our targets in the 22.50 to 23 area on UUP. We think that's very doable, and that may actually occur even as commodities rise. The dollar is a little bit overbought here, but there are so many euro fears, as you know.